So, next, home insurance. Now, this is a difficult topic to go over because we really don't know the degree at which. Well, I'll read the headline and we'll go over it. So, right now, Wall Street Journal found that the 5 largest insurers show 44% non-payment rate in 2025, up from 36% a decade ago. I'm not going to get into the actual specific companies just because I don't want to open myself up to any risks, but any unnecessary risks. But there's some numbers that are at over 50%, and even over 60%, which is great. It's crazy to think on the surface that over half of claims are being denied. But here's the thing. Here's the question. And similar to last week, how I was saying credit card defaults are increasing, and is that because people are working 3 jobs and they can't afford to pay their bills, or is it because they're giving up? Both are. We know it's happening, but we don't know why specifically, and that is something that you need to think about and take into account because it means 2 very different things. Like Japan and South Korea, both very hardworking cultures. If we saw very, very hardworking cultures, if we saw credit rates, decline, we'd be like, all right, these people are working. They have a culture of working 12-hour days every single day. There's got to be something going on with wages. In America, it's really up in the air because I know a lot of hardworking people, and I would preface, this is a hardworking country. There's a lot of people. I actually get pretty offended when people say that there's not a lot of hard workers. I know I personally work very, very hard. And I would assume that these numbers are coming from hardworking people, but we need to understand that there is a welfare portion of this country, and there are people who take advantage of that system, and it needs to be accounted for. So we don't know the specifics of this, and that same mentality has to go into this case also, where we see on average 44% of these claims aren't being resolved, and they're being declined. And basically, declined versus money paid out is being kind of counted as the same thing here, but there is a difference. Being declined versus not being paid, some of these claims may just be faulty claims. And that kind of goes in, it would correlate with, seeing that America's credit rate, America's discretionary credit defaults are increasing, right? So we're seeing these defaults increasing. People might be getting desperate and trying to put claims on their home to get payouts, right? So, and then the insurance company might be sitting there. This rise may be from the consumer base, not because the insurance companies are cutting costs. That's the point I'm trying to get out there to people is, look, we're at 44%. It's increased 8% over a decade, and we're seeing some insurers are over 50% denial rates. But at the same time, we see credit defaults increasing. And what's another way of getting a quick, fast, and easy primary lump sum payout? People could be opting to make claims on their homes. And that's not to run cover for the insurance companies, because the insurance companies have also not been completely transparent. So, it's just something to think about. It's food for thought. We really don't have a clear answer. But, moving forward from that, and very closely related to that, is even the private credit industry, and this is going to be our third story, private credit, there's a crackdown from regulators. They're saying that, certain institutions are not being completely transparent with their real estate holdings specifically, which is scary. And it's basically looking like 2008 all over again. For those of you who are aware, a great movie to watch is The Big Short. Great cast, star-studded cast. In it, you have a scene where they're going over the bond ratings for the mortgage-backed securities. And I believe it was Steve Carell's character was sitting down with the lady who was getting these ratings together, and he's going to where he's like, you know what you're doing is illegal. I forget if it's him or not, but one of the characters basically sits down with her and says, you know what you're doing is illegal? Like, you're basically selling subprime mortgages as AAA rated bonds, which means that it's the number one, like, you're almost next to guaranteed to getting your money back. Fun fact, the United States is the only bond that is guaranteed by the full faith and credit of the United States. So that's the only bond you can say is guaranteed, or only investment product, or you know what I mean. So anyways, I'm not going to get into the nuanced details of that, but that is a fun fact. But yeah, they're basically saying, you know, this time it's not coming from, you know, a separate institution. It's coming from the banks themselves. They're basically crediting, saying, hey, look, yeah, these mortgages, these properties are at, you know, this price, this rating, and it's just looking like a repeat of 2008. So very, very scary. What's interesting was the credit rates, or the credit card defaults, increased after 2008. Obviously, we can kind of understand why that is, right? After 2008, people lost everything. So naturally, you're going to see more people taking out credit because they're desperate. Now we're seeing something very similar, but very, very different. We're seeing delinquencies rise before any type of market crash. So delinquencies are rising in conjunction with property claims rising, in conjunction with certain legal actions going after certain banks saying, hey, look, your prices aren't accurate, or we don't believe your prices are accurate to what you're, or the value of what you're saying, right? And on top of that, a very important note is, I just had it and I lost it, but it is a very big important note. It's going to kill me. I had it and I lost it. But yeah, I mean, that is important. We're seeing all three of these things moving at the same time, but people are desperate, moving into what could be a 2008 scenario. So, you know, it's 6 of one, half dozen of the other. It's, you know, there's a lot of advisors, myself included, who understand that, you know, the market is not as firm as we'd like it to be. And then this is one of those exploits. And even when they set up fiat currency, they literally said the market's going to go in boom and bust cycles. And that's one thing that investors should be aware of. Like, every investor should be aware that it's a boom and bust cycle. It was designed that way. Any market analyst who knows anything about fiat currency markets knows that it has a natural ebb and flow. Every market generally does, but more so fiat currencies, the one that we're in, has an ebb and a flow. Again, not to get too much into my strategies and the, you know, information that I license, but I absolutely take this into account, and I know a lot of other great advisors who take this into account. And sometimes when I look at a buy and hold strategy, and this is not actionable, do not take action on this. Absolutely speak with an advisor. Because again, this is the reason why I'm in this, is because if you're watching this, you're probably not like me. You know, there's probably very few licensed advisors who are actually watching this right now and even made it this far, because I'm just saying a bunch of stuff they already know. The oil thing might be a little bit more interesting, but you need to understand this right now. I am licensed. I do this for a living. The great colleagues that I have, who I know do a good job, they're licensed. They do this for a living. We watch the market all day long, with certain exceptions, but we stay very, very informed with the market. The reason I do this specifically is because I am not comfortable that citizens of this country are forced into a gambling process with their life savings every single day, their entire life until retirement. From when they start working to when they retire, their entire life savings is on the line. And just because they were born at different times could mean the difference between somebody retiring and somebody working for the rest of their life. I'm not comfortable with that at all, and that's my primary motivation for doing what I do today, is specifically that. so that I can help people navigate the markets, and I would like to think that my services give them a fighting chance of making their life what they want it to be. So please, got a little bit animated there, but that's exactly the point. That's why I do what I do. That's why I license research, and I believe that my research has had a really good track, or the research that I license, the people that I work with, have had a really good track history, and past performance doesn't guarantee future returns. So I do need to throw that out there. We could be wrong. Anything can happen. And that's another thing, you as a client or listener should be aware of. Anything can happen. There's no one perfect strategy. Even the strategy that we use could fail, and we'd have to hit the drawing board again. And that's like an uncomfortable thing. It could. I would hope that we've done enough research, and there's a lot of supporting data that it can be effective in the future. And I'm really like tiptoeing around a lot of things here, but it's important for you as a client to know there's going to be boom and bust cycles. That's written into the market and the way it works. And there's strategies that attempt to take advantage of that, and kind of defend against big drawdowns, and then kind of maximize the booms, right? So and that's what everybody's looking for, and some advisors have been able to achieve that in the past, and I will say there's advisors who have been able to achieve that in the past, and then that strategy becomes obsolete, and that is a fact. So that's probably the best way I can put that out. But yeah, so, we're just looking at another kind of 2008 situation where the credibility of, oh, that's right. And here's the other thing of so we have higher delinquencies and credit rate. We have increased insurance claims. Basically, people are saying and think about it, people are probably saying, this home sucks. I want to get out from under this home. Rather than sell it, which I probably can't do because nobody's buying, I'm gonna make a claim and have the insurance company buy me out of this house, right? So that could be a very legitimate strategy. You see that even the banking institutions are saying, yeah, look, the home is worth X, and people like the regulatory agencies are saying, actually, it's not. We don't believe you. This doesn't add up. And then on top of that, you have the same institutions are having people pulling out and redeeming their shares at a much higher rate than they should be. And they've actually some of them had to stop and halt and say, hey, we can't have anybody redeeming any more shares for the time being. When they do that, I shouldn't say every, but the market does that. The New York Stock Exchange does that during sell-offs. And they're only allowed to do that 3 times a day. And at the third time, they shut it off completely and nobody can trade. And you're basically seeing a small version of that inside the market currently. So, it's interesting. We'll see what happens.